litigation and legal costs hitting, well, in particular UBS and Deutsche. Should we be surprised by this?
I don't think we really should, to be perfectly honest with you. I think the capital ratios that will be required by the regulators, and of course the litigation fees for any involvement in the Libor scandal, were obviously going to hamper the profits. I think what has also been to the detriment of these banks has been how the Fed really wrong-footed the markets back in May, and has had a really big effect on their sales of debt trading, down by 48% in Deutsche Bank. So certainly a bit of a shocker in terms of the profit fall for Deutsche Bank, but not unexpected really.
And what about Lloyds? Well, let's put it in this context. Which is a buy for you out of the banks?
I think Lloyds has a huge amount of bullishness about it at the moment. Yes, earnings per share may have actually slipped a little bit according to expectations, but I think it's come a long way from its bailout of around 21 billion back in 2008 from the government. It is also planning to return a lot of its earnings over the next couple of years to the shareholders. So it has a nice firm base. It seems to have a lot of transparency and openness about it that the other banks don't necessarily have, and from that point of view I do feel there's a lot of upside for that bank.
Okay. BP also out this morning. Again, compensation is the big story here, but these don't look too bad.
Not too bad. Obviously, if you look at it in terms of the margins on the oil refinery from this time last year, it is considerably well down. They have got, disposed of about 60 billion worth of assets and looking to dispose of another 10 billion more. Certainly, we're not 100% certain how big these litigation costs are going to be, but there is a large amount of money set aside for this litigation. Nonetheless, I do feel oil companies will feel the pinch for a number of months, particularly with the way oil prices are down below that $100 per barrel mark. So we'll be watching that very carefully, but I don't anticipate seeing those highs that we saw back in 2010 for a long time to come.
All right, and the backdrop, of course, is the Fed this week, Fed minutes. There's a lot of noise around this. Is that warranted?
I don't know. I always think that people get a little bit excited, overly excited about communication from the Fed, and obviously we've been disappointed in the past. What's interesting to note now is that every single investment bank seems to be pushing out any Fed tapering until March of next year. I think we could, maybe in December, when we've got two extra employment reports from November and December, we could see a mild tapering back off bond purchasing. Maybe not in the mortgage end of things, but certainly in the other aspect, and that could be something that we could see before Bernanke takes leave. So I wouldn't be hanging my hat on a March taper in full, but certainly we could see a degree of pulling back maybe at the end of this year.